Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. There's been so much focus lately in the buy now, pay later space, led on the ASX by Afterpay and Zipco. But one of the most interesting stories in the sector is actually another company, and one that many Australians may not have heard of. While Zebit is listed on the ASX with a market cap of around $130 million, it's only active in the United States, where it services the huge and growing number of people considered to be living paycheck to paycheck. Marc Schneider is the co-founder and CEO of Zebit. Marc, welcome to Fear and Greed.
Thank you very much. I appreciate time with you today.
Can you give me a thumbnail sketch of what Zebit does?
Yeah, at the highest level, there's about 120 million consumers in the United States that are shut out from mainstream credit. So Zebit is an e-commerce company. We have our own way of underwriting people, and we give them the ability to buy from us and pay over 6 months without interest, fees, or penalties of any kind, giving them a first-class e-commerce experience and financial stability in being able to chunk up their payments over a reasonable duration of time.
I want to unpack that in a moment, but first, your story is a really interesting one, and one that's allowed you to know or understand your customer base a bit better. Take me through your background.
Oh my gosh. Well, that's an interesting question. Maybe my background is a little bit of a plague, or it's a little bit of a story of a common person. So I've been on my own since 15 years old, put myself through undergrad and grad school, experienced a lot of different financial hardships supporting a disabled mother for about 17 years while I went to school working full time, and really saw how financial stress and the inability to gain access to financial alternatives sort of affected my own path, my mother's path, and soon to be, people that I was meeting throughout my life. And so my childhood in growing up in sort of a disadvantaged financial state sort of focused me on, trying to do something that was very different and give something back to the community, with a social mission and a company that was going to make substantive change. And long story short, after 30 years of being an operator and working in different countries with different industries, I founded Zebit in 2015, and I thought, I'm turning, I think at that time, 46 years old. I really needed to do what I wanted to do since I was growing up, which is create a company that could help people in a material way get back on their feet, get a fair deal, and really hear from our customers that we're making a difference in their lives.
So how many people are in that cohort that you're talking about in the US?
Yeah, they're about, 47% of the adult population has either an impaired credit score, which is defined as a FICO score here in the US, or no credit score at all. And it amounts to a little over 120 million people that really are shut out from mainstream credit. And it's a growing population. It's the largest invisible population in the country, where literally almost no innovation over the last 30 to 40 years for many of our tech centers, government institutions, et cetera, has gone to make improvements. Everybody's going after what I call the luxury customer, right? Middle-class America, upwards of upper class, who have financial stability, who can afford credit cards, they have open to buy, they might need a little float in terms of spreading out their payments, but really no innovation going to the majority of people in this country that are desperately craving it.
So that 120 odd million, and I'm going to sound really ignorant here, so I do apologize for that. Are they bigger credit risks than the middle class and upwards, or not?
They are. They are inherently credit challenged. They're called credit challenged, underbanked, underserved, subprime, as a definition by one score, which is their credit score. Now, people face financial volatility throughout their lives here. And when they get off track, it's very hard to get back on track. Most of our customers are working 2 jobs, they're supporting families, but really the product structures that they get exposed to. We have 3 very big industries here in the United States. Rent to own, where you can get a subset of products in electronics, furniture, and appliances. And that product structure is set up for a small number of SKUs where you pay anywhere from 200% to 400% over retail. And if you miss a payment, your product is repossessed. To lease to own, where you can get in, let's say, to a higher end handset device like an iPhone or a new Samsung. Here in the state of California, for a $1,000 phone, you get the pleasure of paying $3,800 for it over a 17 to 22 month period of time. And if you don't qualify for that, you can take out a 400% APR loan from a payday lender and then go buy the things you need. The key to all of these structures are these products are designed to fail. The underwriting is relatively sloppy and the goods have to pay for the bads, which means the good people that do pay back have to subsidize all of the bad people.
They're paying the 400% in full.
Exactly. In 2019 alone, Sean, this country had the pleasure of experiencing $66 billion of interest, fees, and penalties associated with my customer base to be able to experience these products. And 26 billion of the 66 was simply non-sufficient funds or overdraft charges from merchants trying to take money out of a customer's bank account, and it failed. And when that failure happens, that customer gets hit by a $15 to $105 charge. So think about being in a product structure that's already designed to fail. You're going to fail, and then you're going to get hit with interest, fees, and penalties. So you're trapped by a cycle of debt. So yes, this customer base, back to your question, is inherently risky. And what Zebit has done is we built our own data, our own proprietary underwriting, given there's no off-the-shelf credit score we can pull and know whether our customers will pay us back, and given them a value proposition that's fair, where they actually elevate us up in their own payment hierarchy, consolidate their purchases with us, and pay us back over time. So I've always thought that if you give somebody a fair chance and you level the credit playing field for them, you give them a fair proposition that helps them, that they'll pay you back. And we have experienced that over the last 6 years and proven that we can take a inherently risky customer and turn them into a reliable shopper and a phenomenal repayer.
Stay with me, Mark. We'll be back in a minute. My guest this morning is Marc Schneider, co-founder and CEO of e-commerce group Zebit. So what are your credit defaults like compared to other buy now, pay later operators?
Yeah, so the models are fundamentally different, and so are the metrics. The buy now, pay later players are typically reporting revenue on a total transaction value basis, but that's really not their revenue, right? So if they sell $1,000 good, they're really only making 1% to 3% commission. So the equivalent is if I do $100 million of revenue, which is really the gross merchandise value because I'm the e-commerce merchant here, not just a payment mechanism, that's almost equivalent to about $1 billion of sales on a buy now, pay later player like Afterpay, Sezzle, Affirm, etc. Because our gross margin is much bigger. On average, we're in the 26-27% range, and their commission structure is sort of 1% to 3%. If you really look at their financials defined by their gross margin dollars, I think you'll find that their bad debts are in the 30+% range. But optically, a lot of investors look at bad debt as a percentage of total transaction value, which is, it's not like for like. For us, we reported in our FY20 financial results, bad debt of 10.5%. Now, bad debt differs whether it's a first-time customer coming on the platform or whether it's a tenured customer that's been on our platform for 2, 3, 4, 5, or even 6 years. And the phenomenal and the transformational part about why our value proposition is so healthy for customers is once they've paid off an order in full over 6 months, right? Not 4 payments over 4 to 6 weeks, but 6 months of equal installments tied to their pay date, we see a huge decline in expected bad debt, almost to the 10% range. And then people that have been on our platform for 2, 3, 4 years down to about 2%. And so what we're building here is, as we have a customer that's consolidating their purchases with us, their bad debt is going down over time. And we're rewarding them for their financially responsible behavior with more credit line, lower down payments of checkout, et cetera. But our weighted average bad debt last year was 10.5%.
Okay, so what sort of products and what sort of values are people in the Zebit system buying, and what's the value of those products generally?
Yeah, so we have about 100,000 active SKUs on the platform at any one time. SKU being a product. So we have 25 different product verticals, everything from electronics, home, fragrance, jewelry, beauty, tires, etc. So we try to be a one-stop shop for our customer, as well as we're the only company in the country that actually can finance an electronic certificate for another retailer. So for example, if our customer base wants to go on a vacation, they can buy a Delta Airlines ticket, they can buy a hotel at hotels.com, etc. So the average order value of a first-time purchase is around $400. So when a customer first experiences Zebit, they tend to spend about $400 of their spending limit. On average, a customer is getting around a $1,250 to $1,500 spending limit that they can use on Zebit. And then a repeat order is sort of in the, I would say, $260 to $280 range.
Okay, so it's quite significant.
It is. It's much higher dollar value than what you would normally see, but it's really around payments for our customers, around how much can they afford every pay date to be able to expend relative to their income. And we look at the affordability of the customer, how much income they have. We try not to exceed a spending limit that ever goes over 5% of their gross income as a way in which to try to protect somebody, not to push them over the point of inflection.
Okay, and Zebit makes its money just like other buy now, pay later, with you mentioned earlier on, without interest and fees. It's the retailer who's actually providing the revenue stream for Zebit?
No, actually it's the opposite. So where a buy now, pay later company will get a commission off of financing that purchase, Zebit is actually the retailer. And so we make our money just like any other e-commerce store. The difference between the cost of goods sold that we can acquire the product at and the price that we set for that product. And our average gross margins are 26, 27% on a weighted average basis across all of our categories. So we're making our money just like any e-commerce company, but we've invented our own buy now, pay later solution that's based on our own data science and analytics.
So in a sense, it's a misnomer to call you you are part buy now, pay later, but only part.
That is exactly correct. It's really interesting. I mean, I've done a bunch of stuff in my career. I've been fortunate to work with some really great people across a bunch of different models. This is the hardest business I've ever done because it's a new mousetrap, right? When you're building a better mousetrap, everybody says, oh, you're just like this, but you do this. Here, nobody has done this before in the United States. And it's very hard to find, well, what are you exactly like? You're part retailer, and then you're doing your own in-house credit solution. And yeah, we're a mix between e-commerce and fintech.
I mean, the obvious question then for us here in Australia is, why did you list on the ASX and not in the US where capital markets are a lot deeper?
Yeah, that's an excellent question. I appreciate you asking me that. So I've been looking at the ASX for the last 2.5 years. First of all, a company of our size, sub $100 million of revenue, could really never list on NASDAQ or the New York Stock Exchange. The ASX is kind of like that exchange back in the 1990s, where a company of my size could have been able to get access to the capital markets at that stage. But now you have to be a $1 billion, or you have to go into what's called a SPAC. And if you're in a small SPAC, you could be stranded with no liquidity on the market. So we started as a venture-backed company and raised about $55 million of venture capital before thinking about how do we get access to sort of no preference capital in a market that is liquid, and with a market that could continue, we can raise capital off of as we're scaling the business to profitability. I saw my peers go down to Australia, whether it was Credible or Revasum or Pivotal or Life360 or Charlie at Sezzle. And then I met with the ASX a couple times and I thought, well, this is a really interesting way to raise capital. We have Afterpay that's done a phenomenal job at socializing buy now, pay later. We have an investor set that I think really needs diversity and values, different models. And we made the decision, after 2 trips down there and visiting 50, 60 different institutional investors, that this was a market that we would like to raise capital and have a long-term commitment to, knowing there's pros and cons, right, in any capital raise that you do.
You listed late last year and it was a tough start, but you've climbed back up and your share price has done very well after that initial fall.
Yeah, you could plan for, and we're really good at execution. I mean, I was a CEO for the last, I think, 3.5 years, but I've been an operator for the last 30. And we planned for the IPO to have absolutely zero sell down. I learned from my peers around how do we support Australian investors. So we voluntarily escrowed all of our investors as well as management to stand behind. And there was one investor that wasn't escrowed that unfortunately sold their fund and liquidated, and I think started what we call a run on the bank. So there was a disappointing start, a little bit of an anticlimactic start. But I think after we've demonstrated our FY20 results in the first half of our prospectus forecast, we've seen a nice increase to the stock price over time, which is good, but that's not really what we're focused on. We're really focused on creating long-term shareholder value and getting this business to profitability to get some real returns for investors.
We'll be back with more in a moment. I'm talking to Zebit co-founder and CEO, Marc Schneider. It's not a philanthropic exercise you're doing. You have just identified a niche in the market that is underserviced in a huge market. 120 million people is a lot of people. You don't need all of them. In that sense, it's not philanthropic. It's actually there for shareholder returns, and you're servicing that niche in that market.
Yeah, I think it's profit with a purpose, right? And we're not profitable yet, just to be clear, because I don't want to deceive anybody in that respect. But that is our goal, to break the plane of full year profitability over the next, hopefully 12 to 18 months, and try to accelerate that through potentially another injection of capital over the near term here. But yeah, I think if we're giving the customer a fair deal and we're consolidating their share of wallet and we're getting the benefit of extraordinarily high repeat purchase rates and patronage over time, we can generate a fair profit and give that back to investors over time. And I've been in a lot of e-commerce companies. I've never seen a consumer be so attracted to this value proposition. And it's likely because there's not a lot of next best alternatives for them. But yes, we are a profit-driven organization that also has a fair and what I call a white hat proposition to the customer, where we're trying to do no harm, actually enable them to be financially more stable. And, everybody talks about environmental, social mission. We are a mission-focused organization trying to drive substantive change to a consumer base that has been really beat up. And we're trying to do it in a way that is responsible and also, generate a return for investors who trust us with their capital.
A mission-based company taking on Afterpay and Amazon. That's pretty impressive. Any plans to bring your products to Australia?
Well, Australia, we actually just signed our first Australian e-commerce company that is using Zebit as a distribution channel. I mean, when you want to get access to, over 800,000 customers and you're selling out of Australia, but you can deliver in the United States, here you have no marketing acquisition costs. You have access to a consumer base and you have no transaction risk. And they have plenty of margin in their clothing in order to share that margin in order to get incremental sales. On coming to Australia, you guys have a little bit of a different, I would say, credit spectrum than we really have. You have a nice social safety net. I'm not saying you don't have poverty, et cetera, but the extent of people living paycheck to paycheck, living on the line, not being able to afford healthcare, rent, et cetera, it's different. So I think our expansion is we have a huge market in the United States that we're going to continue to grow. And when we do expand, it will be in either Europe, because credit has been sort of wiped out there, in Latin America, where this methodology is more well understood, or in Asia. So again, having Australia, especially if we go into Asia, countries like India, et cetera, it's a nice base to jump off of. But I'm not sure the Australian population yet needs Zebit, given the other credit alternatives that your consumers have access to.
Fair enough. Marc, thanks for talking to Fear and Greed.
Oh, it's my pleasure. I really appreciate the time you spent with me today. And I always appreciate the chance to educate investors and to hear the story. So thank you very much.
That was Marc Schneider, co-founder and CEO of Buy Now, Pay Later company, or as we just found out, e-commerce company with a bit of Buy Now, Pay Later included, Zebit.